wants to take as few people along for the ride as possible, and you have to keep your perspective. Um, they try and tell us that this was the Chinese dumping like 1 million ounces of gold. Let's just put that in perspective. So,
Gold trading can be confusing in the finance world. Recently, a significant event has stirred discussions among investors and analysts alike. Reports indicated a supposed dump of 1 million ounces of gold by China. This makes people wonder if someone is messing with the market and what really makes gold prices go up or down. We're going to look at what this could mean, while also thinking about the bigger picture of the economy. Understanding the situation. When discussing the recent gold market fluctuations, it is essential to maintain a proper perspective. Central banks, including those in China, are not likely to revert to previous strategies of buying treasuries while selling gold. This shift indicates a fundamental change in how these entities view gold as a store of value. The current market turbulence is not merely a passing phase. Instead, it marks the beginning of increased volatility and sharper price swings in the gold market. To put the alleged gold dump into context, we need to examine the facts. While it has been claimed that China dumped 1 million ounces of gold, we must consider the broader picture. In April, Chinese gold-backed ETFs experienced inflows that surpassed the total for all of 2024 within just the first 11 days. This surge in demand contradicts the narrative of a massive sell-off. Furthermore, during this period, Chinese markets were closed until May 5th, leading to speculation about possible manipulation during these trading hours. Market manipulation and speculation. The gold market is often susceptible to manipulation. The timing of the alleged gold dump coincides with the closure of Chinese markets, raising suspicions about the motives behind it. Major financial institutions may have exploited this situation to drive down gold prices. Observing price movements on a continuous 24-hour chart reveals a recurring pattern. Gold prices tend to rise during Chinese trading hours, only to be suppressed as they enter the New York market. Goldman Sachs reported a 31-ton dump of gold without specifying whether this occurred on the Shanghai Gold Exchange or the Shanghai Futures Exchange. This lack of clarity is significant. The Shanghai Gold Exchange typically delivers fewer than 4 tons of gold per day. Therefore, the majority of this so-called dump likely occurred in the futures market. This distinction is crucial as it indicates that the physical gold market is not experiencing a sell-off. Instead, it suggests a strategic move within the futures market to influence perceptions and investor behavior. Delivery contracts and demand. As we look closer at the U.S. market, we observe noteworthy trends. For the May gold contract, 936 contracts stood for delivery, marking the second highest level for a non-active delivery month. Similarly, the May silver contract saw 14,813 contracts standing for delivery, just shy of the record set in March. These figures indicate a robust demand for physical delivery, suggesting that investors are not merely speculating, but are keen on securing tangible assets. The longs in these contracts are a mystery. However, their willingness to stand for delivery speaks volumes. This represents ongoing demand at significant levels. Even amid the volatility, the appetite for gold and silver remains strong. It is crucial to recognize that while prices may fluctuate, the fundamental demand for these metals continues to grow. The nature of market volatility. Market volatility is an inherent characteristic of trading. Many investors find themselves shaken by sharp price movements. A drop of $60 or $70 in gold prices, for example, can appear alarming. However, when viewed in context, this drop represents only a small percentage of the overall price. Gold trading at over $3,000 means that even a $300 drop constitutes a more significant percentage shift. Understanding these dynamics is essential for investors to maintain their composure during turbulent times. In the current climate, we can expect to see increased volatility in both the gold and silver markets. The higher the prices climb, the more pronounced these fluctuations will be. It is essential to differentiate between noise and substantial shifts in the market. Much of the panic observed on social media reflects emotional reactions, rather than fundamental changes in the market dynamics. Geopolitical factors and economic health. Geopolitical tensions continue to play a role in shaping market perceptions. While many hope for peace, it is vital to recognize that the underlying economic issues remain unchanged. The fragility of the monetary system, rising indebtedness, and other structural problems persist. Even if geopolitical conflicts resolve, the economic landscape will not magically improve. The interconnectedness of these factors means that investors must remain vigilant and informed. Additionally, the recent discussions surrounding the BRICS nations reveal a concerted effort to unify and strengthen trade relations. More than 40 countries have applied to join this group, indicating a shift in global economic dynamics. The new payment systems being developed by BRICS nations demonstrate a move away from traditional Western financial systems. These developments may have far-reaching implications for the gold market and global trade. Central bank policies and inflation. Central banks are at a crossroads. They face the dual challenge of combating inflation while stimulating economic growth. Recent statements from Treasury Secretary Besant suggest that the bond markets are signaling a need for the Federal Reserve to cut rates. This potential pivot toward easier monetary policy could have significant implications for gold prices. Lower interest rates tend to favor gold as a non-yielding asset, making it more attractive to investors. The current economic indicators, including negative GDP prints and an inverted yield curve, point toward a potential recession. Inflation fears remain elevated, creating a complex environment for policymakers. As the Fed meetings approach, we can expect to see more volatility and speculation about future monetary policies. Investors must navigate these uncertain waters with caution. Emotional responses and rational decision-making. Market emotions can often cloud judgment. When faced with sudden price drops, many investors may feel compelled to shift their strategies hastily. However, it is essential to take a step back and evaluate whether any fundamental changes have occurred. The underlying issues of debt, economic fragility, and geopolitical tensions remain. Emotional reactions can lead to poor decision-making, and it is crucial to remain grounded in reality. Many investors may consider shifting from a risk-off to a risk-on approach during times of volatility. This reaction is understandable but often misguided. The structural issues in the economy persist, and the fragility of the financial system remains a concern. It is vital to maintain a long-term perspective and avoid knee-jerk reactions to short-term market movements. The recent allegations of a gold dump by China have sparked widespread discussion and speculation. As we dissect the implications, it becomes clear that maintaining perspective is crucial. The dynamics of the gold market are influenced by various factors, including central bank policies, geopolitical tensions, and market manipulation. In light of the current economic landscape, investors must remain vigilant and informed. The ongoing demand for gold and silver signals a fundamental shift in how these assets are perceived. While volatility is expected, the underlying structural issues in the economy remain unchanged. As we move forward, it is essential to keep emotions in check and focus on the long-term trends shaping the market. The complexities of the financial landscape require a careful and informed approach. By understanding the broader context, investors can navigate the challenges ahead with confidence. For more insightful discussions on financial trends and market dynamics, be sure to check out the original content by Financial Wisdom on their YouTube channel. Stay informed, stay engaged, and most importantly, stay investment strategies. If you're concerned about your financial security and are thinking about investing, check out the first link in the platform I use, Interactive Brokers. Click the link to learn more. We hope you found this video helpful. If you did, please like and subscribe to our YouTube channel so you don't miss out on future uploads.